Hello and welcome to our latest urgent market update video brought to you by the Live Trade Room. Now today is Wednesday the 15th of February and the topic of this particular short video is looking at sticky inflation. We'll explain briefly what it is and we do regard it as a bit of a problem for these market bulls. It is something that they do need to consider. We'll break down exactly why inflation is as sticky as it is, and we look at the issues that it does present for not just central banks but also traders and investors who have been profoundly resilient, certainly since the beginning of the year. So let's get straight into it then. We'll start of course with our risk warning. Just broadly, as always, be mindful of the risks involved in trading financial markets, and do take a brief moment to familiarize yourself with our risk warning currently up on screen. Okay, so let's delve straight into this topic then. So first of all, let's just take a little step back and we'll see kind of where we're at with these markets. And I think we probably need to go back initially to last week's FOMC. So if I just do that now, last Wednesday, have I got the right dates? Of course, it's yes, sorry, it's actually the 1st of February. So that's longer than a week ago. We're 2 weeks ago now. 2 weeks today, actually. We had the FOMC. That shows you how fast time is flying at the minute. We saw a bit of a slowing. This was a good opportunity for the Fed to really drive home their narrative in terms of pushing rates to a level that begins to really have a very significant impact on inflation. Now, many argue that they've achieved that net result, and that is a fair argument. Oil prices have rolled over to the downside, and we've seen inflation lower quite considerably from 9.1% to the more recent figure of 6.4%. So that's always regarded as kind of the low-hanging fruit, so to speak. From 6% down to kind of 2%, which is kind of central bank targets, there's a lot to do. So the Fed had an opportunity on the 1st of February to just send a strong signal that they are going to meaningfully stick to their convictions, that they are very hawkish in terms of the number one threat is inflation, and they really want to make steps to make sure that inflation does get under control and we do start seeing inflation revert back to normal levels, or let's say targeted levels. But the Fed decided not to take that opportunity, and instead of tightening these financial conditions even further, they gave a green light to these markets to actually loosen these market conditions, and we think that's an error. Firstly, secondly, it's likely to present some really good opportunities. The question is, when will it present these opportunities? Now, if we take this into consideration, there was a debate whether we'd get a 50 basis point rate hike in the last meeting, or a 25 basis point or a 50 basis point rate hike. And we actually saw a 25 basis point rate hike. So what the markets and traders and investors took from that is we've seen some sizable rate increases in a relatively short period of time. And then they started to slow down their rate hiking cycle and started talking about the forces of deflation and how entrenched they were. And it was like a little bit of a victory lap in terms of, look, we've done it. We've kind of I suppose I'm being crude here because the markets are taking what the Fed said perhaps out of context a little bit. They're still saying that they might need to continue to raise rates, but they're all talking out of both sides of their mouths at the minute. And to give the markets a green light and those buyers to jump in and start pushing prices higher in the face of still raising rates and high inflation is for us a bit of a problem. So then we heard from all the central banks. So let's bring it up to the CPI numbers and the inflation figures. I suppose it's important to note that we've still got a very a very choppy jobs market in the US. I'll draw attention to that here. Non-farm payroll numbers. We're expecting 193,000 jobs to be added to the US economy, and as you can see, we saw 517. So we've got high inflation, we've got high rates, and we've got really low unemployment. So how does that impact these market conditions as we see these inflation numbers come into view? And on the left-hand side there, you can, of course, you can see the fact that these central banks are in a rate hiking cycle. So let's go back then. We initially, if you go back to Monday's Swiss economy inflation numbers coming in above expectations, so that kind of sets a little bit of a kind of a worrying tone. We had RBNZ inflation figures coming in, significant numbers, way above target. So that kind of feeds into that kind of narrative as well. But of course, yesterday, the 14th of February, we saw this. Let me bring up and let me highlight this event here at 1:30 yesterday. So we actually saw a sizable 60 basis point move from 7.1 to 6.5 in the previous CPI numbers in January. So we had inflation really coming down significantly, and we were expecting, the rate of deflation, should I say, to slow down considerably. We were still expecting a 30 basis point improvement in inflation numbers, and we kind of failed to get to that. So we actually saw inflation start ticking higher year on year. And if you just compare and contrast the previous monthly inflation numbers, the headline and core CPI as well, you'll just notice that there's a sizable deviation. You're talking about a 60 basis point uptick in monthly CPI from the previous month. And there's seasonal factors, and there's a whole range of different factors that feed into that. But these figures came in line with expectations. So I suppose the word we'll use is sticky, i.e. that we're not seeing sizable improvements on CPI. So that victory dance a couple of weeks ago from the Fed, we do think is a bit of a mistake, and we think it could prove to be a bit of a significant problem. And we can also add UK CPI numbers. We're still multiples above expectation regarding CPI in the UK as well. A slight improvement, so inflation's coming down slightly, but we're still over 10%. So there's no victory dance to be had there either from the BOE. So the question becomes, what decisions do we want to make with these markets? And the first instinct was, and if I show you the two narratives, which we can work with this question in mind, these are two major market narratives. So you're either in the camp that the Fed are likely to pivot their rate hiking cycle, which would suggest that interest rates will start coming down, that the impact on the economy is going to be significant, that all of a sudden the Fed will have to pivot, and we can. That's really good news for stock markets. The other aspect to this kind of narrative is actually suggesting that the economy is performing really quite well. So we can live with this inflation story, and still inflation can continue to remain stubbornly high, and it won't have any massive impact on these markets. And under both of these circumstances, we'd expect kind of risk-on market conditions. We'd expect indices to push higher. We'd expect further weakness to continue to come out of the US dollar. We'd expect bond yields to shift to the downside, and we'd expect commodities to push higher, just largely due to a more affordable US dollar. So that's the first market narrative. This is what we've been experiencing pretty much from the so far this year. We've been experiencing this type of risk-on market condition. So what these CPI numbers do and causes a bit of problem for these market bulls is that it's now looking like inflation is going to remain sticky at best, higher. We'll start ticking higher as far as inflation is concerned as a kind of a worst case scenario. But either way, we would expect that to have risk-on, risk-off market conditions to be filtering through these markets. And what does that mean for us as traders? It means we can probably see the indices rolling over to the downside. We can probably see the dollar pushing higher. We can see US bond yields, which is worth just raising, just looking a little bit in terms of the bond. What are the bond markets saying to us? Well, they've clearly sort of made the statement over the last few days that actually all is not well, and they are beginning to rally back up to the upside, which does nothing but kind of enforce this risk-off market condition. So those bond yields are pushing higher. There is a little bit of a disconnect really at the moment between bond yields and equities, but we expect that to sort itself out at some point. The key question for us is timing, is when is the right time to pull the trigger on this risk-off market condition and commodities rolling over to the downside. So we are in the process of really shifting from this risk-on approach to the risk-off approach. And that's just meaning that there's less of an appetite for risk in these market conditions. Now, it still remains to be seen how these markets are actually going to play themselves out. We do have some a bearish bias across the US indices as things currently stand, and we've also got a bearish bias in the euro dollar, pound dollar, Aussie dollar, and gold. So there's the commodities. We wanted to just pause on this video just purely because of the erratic kind of very choppy price action we've seen this yesterday afternoon. Admittedly with a bearish bias to the markets, but we know that these things can churn and turn very, very quickly indeed. So we're not going to take anything for granted, but certainly we are a little bit more focused on the strengthening dollar. And if I just go back to this dynamic here, it's a case of when, and I said there's a disconnect between bond yields, which are pushing higher, and US indices to the downside. So the question now becomes, when we look at markets like the S&P, is that we anticipate that these markets are likely to take perhaps another roll to the downside. The question is, when is this likely to happen? The problem is we could get a nice corrective move from these levels, or we could potentially push higher before we get that move. So either way, we're looking at downside moves. It's just, for us, it's becoming a bit of a problem in terms of, because of the resilience that's sitting in these markets, this out-and-out attitude towards taking a very, very bullish stance to these markets is kind of corrupting what should be happening in these markets. And it looks like today now we're getting, in fact, yesterday's price action was broadly indecisive, and we're seeing further indecision again today. So really, we just want to make the point that it's a case of when. It's not probably a case of, especially if we start seeing unemployment remain stubbornly low, especially if we start seeing inflation, look or give the appearance that we're sticky at best, but probably rolling back to the upside. Again, we'll have to keep a close eye on the oil markets. If they start pushing higher, it's no doubt going to lend itself to that overall inflation story. And that would cause, in our opinion, a big problem for these financial markets. So we're in the process of perhaps switching from this risk on for these reasons, rate pivots, soft landing, to a more risk off market condition, which is based about a hawkish central bank monetary policy, looking at higher rates for longer, and with sticky or higher actually inflation than current levels. So we're in the process of making this switch, which is why those that are just profoundly, resiliently, just buying markets, buying risk, we think are probably going to have their wrists slapped very, very soon. For us, what's proving really quite difficult is when is this move likely to kick in? So being able to stalk and wait for the opportunities to arrive do look like it's going to be the best possible solution for us. So no doubt about it, tentative market conditions at the minute, broadly indecisive depending which indicators you're looking for. If you're looking towards the bond markets and the treasury yields and the dollar, they're very much in sync. And commodities are in sync as well. What's proving stubborn and something we've seen on and off really over the last year, even though we had quite a bearish year last year, is that fighting narrative play out in front of us, literally on a daily basis. So we do need the equities to fall into line. They're not doing so just yet. We don't necessarily think that's the successful trade over the longer term. It is proving successful over the last few weeks. Certainly very stubborn, quite choppy market conditions at the minute. If we can ride those out, we're probably likely to get some really good trades filtering through in the not too distant future. So we do think if you do have a really strong bias to the upside for these equity markets, we may get further upside from these current levels, but we would anticipate inflation taking hold in these markets at some point. And that's why we think the Fed have missed the opportunity to really address the inflation story. They've left the door half open. So as a result, we are waiting patiently for those moves to kick in. And when they do, they're likely to be significant. So good. Look, that just concludes this short urgent market update video. You may have certain questions about anything covered in this video. So do feel free to email us at support@thelivetraderoom.com and we will get back to you as soon as we possibly can. So look, thank you very much for joining us. As always, do stay tuned for our next video. We do broadcast, just to let you know, our trade plan live sessions at 7:30 a.m. every single morning. We can't stress how important it is to plan your trades and then trade your plan. It does stop you from getting chewed up in these markets. So it's a really useful methodology. And then we trade live every day, Monday to Friday, of course, from 8 a.m. for the European trading session and again at 12:45. These are all UK times, by the way, for the US cash open. So if you want to join us for those high volatility, high volume periods of the trading day, then we can certainly help you with that. So for more information, just go to thelivetraderoom.com and you feel free to contact us as well through the chat function on the website if you need. Great stuff. On that note, guys, thanks so much for joining us as always, and stay tuned for our next video. Bye for now.